Imagine waking up on a completely normal Tuesday 20 years from now. You roll over, grab your phone, and open your investment app half asleep. You're not expecting anything special today, but the number hits you in the face immediately. Yesterday, while you were at work doing your regular 8-hour shift, your investments quietly earned more money than your take-home pay for the day. Your portfolio made more than you did. And it is not the first time this has happened. It is starting to happen more and more often. That feeling, right there, is one of the most powerful moments in personal finance. There is a name for that moment when your money finally works harder than you. It is called the crossover point. Most people will work for 40-plus years and never even realize this moment exists. I do not want that to be your story. My name is Max. This is Max Invests. I make videos that help you understand money in plain language, without the fluff, without the jargon. If you care about getting your finances under control, building wealth on purpose, and using money to buy back your time, take 2 seconds, hit subscribe, and tap the like button right now. It helps the channel way more than you think, and it tells me to keep making videos like this for you. Today we are going to break down exactly when investment income finally beats your day job, why it is not some vague dream for tech millionaires, and how you can calculate your own crossover point step by step. No hype, just math you can actually use. Let us start with one simple idea. The crossover point is the moment your investment income covers the cost of your life. Not the cost of your dream mansion and sports car lifestyle, just the cost of a normal, decent life that you actually enjoy. When your portfolio throws off enough income to pay your bills, whether you show up to work or not, that is the day your job becomes optional. You can still choose to work, but you are no longer forced to work just to keep the lights on. This is not philosophy. It is not manifestation or positive thinking. It is math. And once you see the math, you cannot unsee it. Think back to school for a second. Everyone understands the difference between an A and a C. Those letters tell you exactly where you stand. The crossover point is like getting an A in your financial life. It is a clear benchmark, not a fuzzy feeling. So how do we actually calculate this thing? Let us build an example together. Imagine your total monthly expenses are $4,000. Rent or mortgage, food, transportation, insurance, your phone, internet, basic entertainment, and a little room for fun. Multiply that by 12 and we get $48,000 per year. Now, there's a rule of thumb in retirement research called the 4% rule. Very short version. If you have a broadly diversified portfolio of stocks and bonds, historical data suggests you can withdraw around 4% per year, adjusted for inflation, and have a high chance of not running out of money over 30 years or more. Is 4% perfect? No. Is it simple enough to give you a starting point? Absolutely. So if your life costs $48,000 per year, how big does your portfolio need to be so that 4% of it equals that number? Take $48,000, divide by 0.04, or multiply by 25. You get about $1.2 million. That $1.2 million is your personal crossover number in this example. At that level, your investments can reasonably throw off $48,000 a year, which covers your $4,000 per month lifestyle. Work becomes optional. Again, this is not some mysterious thing. It is just basic multiplication. The uncomfortable question is not whether the math works. The question is how long it actually takes to get there and what you can do to shorten that distance. To answer that, we are going to follow two people with the same income but very different behaviors. Meet poor Peter and rich Richard. Both are 30 years old. Both make $60,000 a year from their day jobs. But their choices over the next 30 years lead to completely different destinations. Poor Peter does what most people do. He invests, but not aggressively. He decides he can spare $500 a month for investing. He earns an average 8% return over time. His monthly expenses are around $4,000, just like our example. At age 40, after 10 years of investing $500 per month, Peter has around $90,000 in his portfolio. At a 4% withdrawal rate, that portfolio could spin off roughly $3,600 per year, or about $300 a month. That is something, but it is nowhere close to covering his $4,000 in expenses. The lines between his living costs and his investment income are not even thinking about meeting yet. Fast forward to age 50. Peter keeps investing faithfully $500 a month, year after year. Now he has around $275,000 invested. 4% of that is about $11,000 per year, or roughly $900 per month. Better, but still far from the $4,000 he needs. At 55, after 25 years of consistent investing, Peter has around $430,000. 4% gives him about $17,000 per year, around $1,400 a month. The curve is starting to steepen. Compounding is waking up, but he is still a long way from crossover. At 60, 30 years in, Peter has roughly $670,000. That throws off around $27,000 per year, about $2,250 per month. Now he is more than halfway to his $4,000 expense line. Finally, around 65, Peter gets close to $1.2 million. He only truly hits his crossover point right around traditional retirement age. Let us be clear. Peter did a lot right. He invested consistently for decades. He did not blow everything. But he still had to trade 35 years of his working life for that result. That is the slow path. Now, let us look at Rich Richard. Same age, same income, $60,000 a year. But Richard makes two key decisions that change everything. First, he trims his monthly expenses from $4,000 down to $3,000. He does not move into a tent or live on rice and beans. He just makes deliberate trade-offs. Smaller apartment instead of the luxury place. Older, reliable car instead of a new lease. Cooking at home most days, ordering in sometimes as a treat. Second, because his expenses are lower, he can invest more. Instead of $500 a month, he invests $1,000 a month. Same 8% return as Peter. Right away, Richard's crossover number is different. $3,000 per month is $36,000 per year. Multiply by 25 and you get around $900,000 for his crossover. He does not need $1.2 million anymore. He needs $900,000. That is $300,000 less he has to accumulate. And he is putting in double the monthly contribution. After 25 years at $1,000 per month and 8% returns, Rich Richard ends up near $860,000. Combined with his lower living costs, he is within striking distance of his $900,000 crossover number around age 55. He reaches what Peter only reaches at 65, 10 years earlier. Same income. Same market returns. Two decisions different. Spend less. Invest more. Now let us take it one step further. What if Richard gets a bit more radical for a season? He house hacks, maybe rents out a room, or gets a roommate. He moves to a slightly cheaper area, he cleans up subscriptions and impulse spending. He gets his monthly expenses down to $2,000. $2,000 a month is $24,000 per year. Multiply by 25 and his crossover number is now about $600,000. With $1,000 per month invested at 8%, he can get to that range in roughly 18 years. Financial independence in his late 40s, not his mid-60s. Same stock market, same human being, different choices. Peter and Richard show you something crucial. The crossover point is not a fixed destination. It is a function of two variables, your investment portfolio and your lifestyle expenses. When you push both of those in the right direction, you pull the lines toward each other much faster. Now we need to talk about something people almost never discuss. Most of the benefits of this strategy show up long before the lines actually cross. I call this the freedom gradient. Most people think financial independence is binary. You are either dependent on your job or you are not. But that is not how it feels in real life. As your investment income grows, you experience degrees of freedom along the way. When your portfolio throws off $500 per month, maybe that is your car payment covered passively. At $1,000 per month, that could be your car and your groceries. At $2,000 per month, most of your non-housing expenses are handled before you roll out of bed. Each milestone does two things. It makes your budget more resilient, and it changes how you feel about your job. You are no longer negotiating from desperation. you have options. There is also a psychological threshold with your portfolio size. For many people, somewhere between $50,000 and $100,000, something clicks. Below that, market moves feel abstract. 2% up or down is just numbers on a screen. At $100,000, 2% is $2,000. You can feel that in your stomach. Suddenly, compound interest is not just a chapter in a book. It is something you experience on a random Tuesday. There is another concept that fits into this gradient. It is called CoastFIRE, or Coast Financial Independence. CoastFIRE is the point where you have invested enough that even if you never contributed another dollar, compound interest alone would grow your portfolio to your full crossover number by traditional retirement age. For example, imagine you are 30 and your target is 1.2 million by age 60. If markets return around 8% on average, you would need roughly 150,000 invested today. From there, you could simply coast. You might keep investing, but you would not have to push nearly as hard. You could switch to a lower-paying job you actually enjoy, go part-time, or take some career risks, knowing your retirement math is already locked in by compound interest. All of this freedom shows up long before your investment income fully covers your life. So, where are you on that gradient right now? If you are comfortable sharing, drop a comment below this video with one thing. Either your current monthly expenses, your crossover number, or your next milestone you want your investments to cover. Reading those comments helps me see where you are on the path, and it helps other people realize they are not alone in this. And if you have not already, hit subscribe so you do not miss the next videos in this series. Now, let us deal with the elephant in the room. If you are thinking, Max, this all sounds great in a spreadsheet, but have you seen the stock market lately? You are not wrong to worry. The market is volatile. We get bear markets, recessions, ugly headlines. Your portfolio can drop 20, 30, even 40% at some point. On average, serious bear markets show up roughly every 4 years. That sounds terrifying if you imagine you are right at your crossover point and suddenly everything falls. But remember, for most of your journey, you are in the accumulation phase, not the withdrawal phase. You are not pulling money out every month. You are putting money in every month. When the market crashes during that phase, you are still buying. Your automatic contributions are picking up more shares at lower prices. It feels awful to watch your balance shrink, but those purchases are actually accelerating your long-term progress. The historical 8% return we are using already includes all of those crashes. It includes wars, inflation spikes, recessions, panics, and everything else the last century threw at investors. Volatility is not some unexpected bug. It is a feature of the system we are choosing to use. What about inflation? Prices go up. Groceries cost more. Rents rise? Here is the good news and the honest caveat. The 4% safe withdrawal rule was built specifically to survive decades of inflation. The original Trinity study tested portfolios across historical periods that included very high inflation, and the 4% rule still held up surprisingly well. On top of that, stocks themselves are an inflation hedge over long horizons. When prices in the real world go up, companies raise their prices too. Those higher prices flow through to earnings and eventually to stock prices. Your crossover number will rise with inflation, but so will your portfolio if you stay invested. Are there risks? Of course. There is no zero risk option in life, but here's the key comparison. Never investing, spending everything, and staying 100% dependent on trading your time for money until your body cannot do it anymore is not less risky. It is more risky. With the crossover strategy, you have a mathematical plan that has worked for millions of people who actually executed it consistently. So, what do you do with all of this information when this video ends? Let us turn it into a simple 5-step plan you can start this week. Step 1. Calculate your real monthly expenses. Not what you think they are, what they actually are. Log into your bank and credit card accounts. Export the last 3 months of transactions. Categorize them: rent or mortgage, groceries, restaurants, subscriptions, transportation, Everything. Add it up month by month, then average those 3 months. Most people discover they are spending 15 to 20% more than they believed. That number is your baseline reality. Step 2. Convert it to annual expenses and calculate your crossover number. Take your average monthly expenses, multiply by 12 to get the yearly amount. Then multiply that by 25. That is your estimated crossover portfolio at a 4% withdrawal rate. Write that number down. It might feel scary. That is okay. You cannot hit a target you refuse to look at. Step 3. Check your current investment balance and measure the gap. Open your retirement accounts, brokerage accounts, and any other long-term investments. Add them together. Subtract that from your crossover number. The result is your gap, the distance between where you are today and full work optional freedom. Seeing that gap might sting, but it transforms the idea of financial independence from a fuzzy dream into a concrete, measurable project. Step 4. Estimate how long it will take to close that gap at your current investing rate. For this, you can use any compound interest calculator online. Plug in your current portfolio as the starting balance. Add your monthly contribution. Use a reasonable return assumption, like 7 or 8%. See how many years it takes to reach your target portfolio size. Be honest about how much you are actually investing each month, not what you wish you were investing. Step 5. Design ways to accelerate the timeline by attacking both sides of the equation. On the income and investing side, could you negotiate a raise, switch to a higher-paying role, pick up a side hustle, or funnel windfalls like bonuses and tax refunds directly into investments? On the expense side, could you house hack, refinance, or downsize your home, move to a lower-cost area, or simply clean up recurring subscriptions that no longer add value? Every extra $1,000 you invest is roughly $40 per year of passive income forever at 4%. Every $100 you cut from your monthly expenses is about $30,000 less you need to reach crossover. Those are massive levers most people never think about. If you have made it this far in the video, you are already ahead of most people who only watch the headlines and never run the numbers. Do me a favor. In the comments, tell me which step you are going to do this week. Is it the expense audit? Is it calculating your crossover number? Is it opening your first investment account? I read those comments and they shape what I break down next on this channel. Now I want to leave you with one last reframe about time and money. Every purchase you make has 2 prices. The price in dollars today and the price in months or years of freedom tomorrow. Imagine you are choosing between a $30,000 car and a $15,000 car. On paper, that is a $15,000 upgrade, but at 8% returns, that $15,000 would double in about 9 years. In 18 years, it could become $60,000. In 27 years, $120,000. When you choose the more expensive car, you are not just spending extra cash. You are pushing your crossover point further into the future. You are trading future freedom for current comfort. I am not saying never buy nice things. I am saying you should understand the trade-off clearly. Money is not just money. It is stored future time. Every dollar you let flow straight through your fingers is a little bit of future time you are selling. The average person will earn around $2 million over their working lifetime. Yet many will reach retirement almost entirely dependent on Social Security, collecting maybe $1,800 per month after 45 years of work. They will have spent nearly every paycheck as it came in. The crossover strategy offers a different path. Not an easy path, but a clear one. Save aggressively when you can. Invest consistently through good markets and bad. Reduce your expenses intelligently, not in ways that make you hate your life, but in ways that align with what you actually value. Then let the math work. The lines will cross eventually if you stick with it. And when they do, you will wake up on some random Tuesday, check your accounts, and realize your money is finally working harder than you are. That is the moment everything changes. If you want more videos like this where we take big financial ideas and turn them into clear, step-by-step plans, make sure you subscribe to Max Invest and hit the bell icon. Share this video with someone who needs a roadmap, not another vague, save more lecture. And in the comments, tell me what topic around money and investing you want me to break down next. Thanks for watching and for caring enough about your future to think this deeply about it. I will see you in the next one. Bye.